Hi, my name's Phil Grove, and I'm a real estate investor. And we're here to talk about the different strategies that are available to homeowners for selling a home. Now, I work with other real estate investors and realtors all across North America, and together we collectively offer pretty much every solution you can imagine for buying or selling real estate with just about any seller in just about any situation. And we're going to go through in this brief video all of the different options and trade-offs that a homeowner today has for selling a home. And hopefully this will allow you to make a better decision as to which option would be best for whatever your situation is. Now, I can tell you that I've worked in a lot of different real estate transactions with a lot of different buyers and sellers, and I know a little bit about real estate. One thing I know about selling a home, for example, is pretty much everybody wants exactly the same thing. Everybody wants to sell their home as quickly as possible, and everybody wants to sell their home for as much as possible. And I can certainly understand that. I'm just like everybody else. But the truth is, when you sell real estate, it doesn't always work out that way. I always like to say that selling real estate, selling a home these days is kind of like winning the lottery, right? You can get the $1 million, but they pay you out over time. Or you can say, I want the lump sum, I want it right now, and you get it right now, but it's a lot less than $1 million. And when you sell a home, you've got a lot of different ways you can sell the home too. Some of them are quick, but you get less money. Some of them you get more money, but it takes time. Now, fortunately, there are many different strategies in between as well, and some creative strategies as well. So we're going to go through all of the different options that today's homeowners have to sell a property so that, again, you can see what the different options are and make an informed decision as to which option might be the best for you and your situation. So before I go through these different options, I do need to make a few assumptions. And I'm going to make some assumptions about, values and things like that by just, explaining all the options for a generic house. So we're going to just pick a generic house, say a $150,000 house with generic situations. And I promise whether your house is worth $50,000 or $5 million, you can just adjust the numbers up and down and plug in the numbers for your particular situation to see which option would work for you. But the math is the same regardless of what your house is worth, and you'll understand that better as we go through this in a little bit more detail. So for our assumptions, for the house we'll explain our different options for, let's just assume we're dealing with a $150,000 house. So the fair market value is $150,000. And that's the current fair market value, by the way. I mean, sometimes people say, well, I bought it for, $200,000 or $100,000 or whatever it was. Doesn't matter what you bought the house for. It doesn't matter what it used to be worth. Doesn't matter what the appraisal said, 6 months ago or 2 years ago or whenever. The thing you have to look at first and foremost is what is the current fair market value? What would somebody reasonably pay today for the house? So the first thing we look at is current fair market value. So for the house, we'll give, in our example, we'll look at a $150,000 home. And then we have to look at what is the balance of all the loans. How much is owed on the house? So for our example house, we'll say that they owe $155,000. Now, whether you owe a lot less or a lot more, in other words, whether you have a bunch of equity because you put a big down payment down or you've had it a long time, or if you have a lot less equity or a lot of negative equity because the house went down in value since you bought it, again, it doesn't matter. You're going to be able to adjust, everything to your situation. But I'm just going to use, again, this generic example so that I can go through these different options. And this is the example I'm using happens to be the most common, home in America right now, and that's kind of why we're using it in our example. So for repairs, we also have to estimate about how much repairs the house needs. I'm going to assume the house needs, negligible repairs. Let's say $5,000 in repairs. If your house is in perfect condition, needs 0 repairs. Again, it doesn't make much difference. It's pretty uncommon nowadays that I don't see a buyer that after they do their inspection finds at least $5,000 worth of repairs. They always want, new carpeting or, something fixed or whatever. So $5,000 repair allowance done by a buyer would be pretty much cosmetic, pretty negligible. But again, that's just in our example. You have to think about what your situation is. And then the last assumption we're going to make is that this is if you sell it normally, then normal closing and sales costs apply. In other words, the cost to sell a home, when you close it, costs about 2% in closing costs, about 6% real estate commissions, and nowadays you're going to have to pay about 2% of buyer closing costs. So the entire cost of sales, the cost to the seller to sell a house, is about 10% of whatever the offer is from the buyer. So those are our assumptions, and now again that we have those assumptions, let's go through all the different options for selling a house assuming those assumptions. And again, what you can do for whatever your situation is just write in your actual numbers, and I'm going to explain all the math so you can figure it out exactly which option would be the best for you for your specific situation. The first option we're going to talk about is selling your home to a cash buyer. If you want to sell your home quickly, and most people do, one of the very fastest ways to sell a home is to a cash buyer. And let's go through the math for a cash buyer. The cash value of a house, if you ask for somebody to buy your house for cash, and there are cash buyers out there, and in general what a cash buyer is going to want to pay is about 70% of the fair market value minus repairs. In other words, cash buyers tend to be real estate investors, and what they're looking to do is buy houses so that they can flip them. And when you add up all of the cost to flip a house, the buyer is going to have to pay closing costs on the purchase. They're going to have to pay acquisition costs, carrying costs, insurance, and payments, interest, taxes, utilities for however many months it takes to buy it, maybe make repairs, put it on the market, and ultimately sell it again. Then they're going to have to pay closing costs again when they sell it. And most people that flip houses, they buy wholesale, but they sell retail, so they're going to have to pay commissions again. So the total cost to flip a house is about 15% of the value of the house. And so when a cash buyer buys a house, they generally will pay about 70% on the dollar because they expect to have about a 15% overhead, and they expect to have about a 15% profit margin. Now, I am a cash buyer, and all of my investor associates are cash buyers, and if the cash offer is an offer that is attractive to you, we can certainly talk to you about that offer. For our example home, a $150,000 house with $5,000 needed in repairs, 70% of the fair market value, 70% of 150 is 105,000 minus the repairs is 5,000, gets the offer down to about $100,000. That's what the cash offer would be on a home. Does this hurt your credit? No. You can sell a home to a cash buyer and there's no impact on your credit. How long does it take? Well, that's the good news. It takes very little time to sell a home to a cash buyer, typically a few weeks. Most cash buyers, we advertise ourselves with We Buy Houses signs. We can generally buy a house in even under a week, but certainly less than 2 weeks. Of course, the downside of a cash offer is, in our generic example, the seller will have to bring to the closing the difference between the loan amount and the offer. In this case, that would be about $55,000. So this is an option that is very fast, but depending on the amount of equity you do or do not have in the home, it's going to basically give you the least amount of money, or if you don't have much equity, it would cost you the most. So this is the lottery example of taking the lump sum. The next offer we're going to discuss is listing your home traditionally with a realtor. I work with a number of different realtors, and we can certainly find a realtor to help list your home. And when you list a home, here's what you can expect. And again, we'll go through this for our generic house. The offer that you would expect to see would be basically the fair market value minus any repairs that are needed. So this house that we're talking about, its fair market value is $150,000. It needs $5,000 in repairs. So you would expect to see an offer for $145,000. Now, obviously, the market's a little tough out there, and you may not get a full fair market value. But if you do wait long enough, you would expect to get the fair market value. After all, the definition of the fair market value is what will you actually get in terms of an offer. So on this house, we'd get a fair market value of $145,000. If you sell a home traditionally, it does not impact your credit. Kind of the downside of selling traditionally is it tends to take a long time. Right now, across North America, there's more than 6 months of inventory for most homes. So that means that on average, it takes more than 6 months to sell a house. Now, there's a little bit of a luck element involved, so, your mileage may vary. It may be a little faster, maybe a little slower. Certainly, if you drop the price more, tends to sell faster. If you want full fair market value, tends to sell slower. And in this scenario, with a $150,000 home, what the seller is going to have to do is they're basically going to have to take a minor, that $5,000 concession in order to cover the repairs. That's reflected in the value. And then, of course, the seller has to pay all of the normal selling costs, which are about 10% of the offer, which would be about $14,500. So $14,500 plus the $5,000 repairs. The seller would probably bring about $24,500 to the table. So the listing option in this generic house example takes 6 months plus or minus and requires about $24,500. However, it does not impact your credit. Our next option for selling the home is using a strategy called a short sale. And I do a lot of short sales. My company's actually done over 1,000 short sales, and we can certainly help facilitate a short sale for you if this is the best option for your situation. Let's go through kind of what a short sale would look like for our generic home example. Typically, when somebody buys a short sale, it's a little bit more, tricky than buying a regular house. So typically, a short sale would sell for about 90% of the fair market value minus the cost of the repairs. So in our example here, you'd sell a house with a short sale. You would expect to see an offer of around $130,000. Again, could be higher, could be lower, but that's pretty typical. Now, the downside about a short sale is it does have an impact on your credit. Whether it works or not, you're going to get a big credit hit. And unfortunately, about 50% of short sales are denied or never actually sell or ultimately result in foreclosure. So you got about a 50-50 chance of a foreclosure, but it will hurt your credit pretty badly either way. How long does a short sale take? Short sales take a long time, typically 6 to 9 months, could be longer. We actually just finished one that took 17 months. It can be a little faster too. There's an element of variability and luck involved. And the good news, though, is that a short sale actually the seller doesn't have to bring any money to the table. Now, there are a few caveats to that. When you do a short sale, you can get a deficiency judgment. In other words, the lender could actually sue you for the loss. They're going to take a loss, a pretty significant loss, because of mathematical things, beyond the scope of this discussion here. They could actually sue you for up to the full value of the loan. You can also get 1099 statements from the lenders. This could mean you have additional tax liability, and there's a number of other, credit and monetary considerations as well. But in general, this is what a short sale looks like: 6 to 9 months, 130,000, and the downside is it hurts your credit, and there may be other financial concerns as well. Our next option is a foreclosure, and there's a couple of variations about this. You could also do something called a deed in lieu, where you just deed the property back to the lender. From a credit and functional perspective, there's really no difference between that. Generally, a lender won't even approve a deed in lieu until you've already tried a short sale and the short sale has failed. So most people, or some people, when they're in a difficult situation, they need to sell a home quickly because maybe they can't afford it any longer. Consider foreclosure as one of their options. So let's go through the foreclosure. What's the offer? Well, there is no offer and there's no formula. The biggest, of course, problem or downside with a foreclosure is the atomic bomb of credit scars. It is the big one that cuts your score the deepest and it lasts the longest. And I know that some sellers think, oh, I'm just so tired of this house. I just want to walk away. I don't want it anymore. I don't want to deal with this. And they think that a foreclosure is kind of the end of the problem. But the truth is that a foreclosure is really the beginning of a 10-year nightmare that starts with, having your home foreclosed on the courthouse steps. If you're still in the home, you get evicted. The sheriff would even drag you and your family out onto the curb with all your stuff. Most people move out before that. But then you have a decade of creditors calling, dealing with deficiency judgments, tax implications, not being able to get a credit card or buy a car, and some jobs will even be affected by your credit standing. In other words, some people even have trouble getting employment after foreclosure. So I guess the bottom line is I would really strongly recommend that a foreclosure is not a very good option, but it is one of the considerations that some people have. Not most, but some people have, depending on their individual circumstance when they're selling a home. The good news about a foreclosure is, right, it doesn't cost you anything, but like a short sale, there can be deficiency judgments, 1099s, and a variety of other financial and credit implications. Our last option is an option called a mortgage assignment. And a mortgage assignment is basically where the seller assigns their mortgage payments to a buyer in exchange for transfer of ownership. In other words, the buyer is going to make the payment on the seller's loan going forward. Now, I do want to explain this is not a loan assumption. A loan assumption is when the lender transfers the loan from the seller to the buyer. And virtually no loans are assumable, and lenders generally don't approve loan assumptions. They would have to requalify the buyer. However, an assignment is a little bit different. An assignment is only approved by the seller, and the seller gets into a contractual agreement with the buyer where the buyer is now responsible for making the payment on the existing loan in exchange for ownership. When you sell a home with a mortgage assignment, just like any type of an owner financing situation, because lending is difficult now because loans are at a premium, when a home comes with a loan, generally that home will sell for a premium. It will sell faster and it will sell for more money. So the fair market value of a home that comes with financing is basically the loan balance. So in this example with our generic house, you would expect to get an offer for $155,000. Is this impact your credit? No. How long does it take? Typically 2 to 6 weeks. Mortgage assignments or selling homes with financing in this way goes down pretty quickly. In fact, we have hundreds and hundreds of buyers, in fact, nationally, thousands of buyers that already are wanting to buy houses this way. So we can basically match these buyers up with these homes in a very, very quick fashion. And of course, the good news with a mortgage assignment is you don't have to bring any money to the table. In other words, it's actually the buyer that's paying all of the closing costs in these transactions. So those are the 5 different options that you have when you're selling a home. We'd be happy to kind of explain your particular situation and see which option might be the best fit for you.